Welcome everyone to the Stearns Financial live chat. Today we have a topic that is the what can go wrong category. And so we've been talking in recent written poolside chats about all the things in our main three pillars of economic and securities recovery that are going right. Today we're going to talk about some of the things that could go wrong. And many of the things we're going to go into today are lower probability but high impact kinds of things. Some of them are things that are unique to this period of getting into the pandemic endgame and the aftermath. Some of them are not unique and are always kind of around. So joining us today, we have Glenn Joyce and PJ Williams, our co-chief investment officers. And let us jump right in. I will mention that questions, please put any questions you have in the Q&A piece, not in the chat. Thank you. And we are recording this and it will be available later for viewing. So let's jump in on interest rates and inflation, which inflation in particular has become one of the most talked about things here lately. You know, back in the days when we tracked the number of mentions in media, I think if we were doing that today, inflation would be off the chart. So let's talk a little bit about how we're feeling about both of these potential wildcard risks.
Thanks, Dennis. So I think this chart is something that clients have seen in the past. We've used this quite a bit. And this looks at the 10-year treasury yield over time, both the nominal or headline number, and also when you subtract inflation, the core inflation, you see the real number in gray. And so we talked quite a bit about the hyperinflation days of the 70s and how Paul Volcker, the Fed chairman at that time, broke the back of inflation in 81, and how since then, it's been a very disinflationary environment, very positive for financial investments when inflation is declining. And so you can see today we're at a very low point, and that number is actually a little bit high. The blue kind of nominal headline 10-year number is 1.53. Actually, we kind of settled below 1.5 in the mid 1.4 range more recently. And it's been interesting because we are seeing inflation start to pick up some. And the Federal Reserve wants to see some inflation, the right amount, the right dose. But we have seen it jump up a little bit, and the market does seem to be buying into this comment of transitory. You'll hear that quite a bit if you haven't already. That inflation will subside at some point, kind of once we get through this kind of opening up cycle and things kind of level off. But that's the big question, is how hot does inflation go kind of in the interim period? So I think as we've seen this inflation pick up, and you kind of think about the real yield, notice how it's negative. And so what that suggests is if that negative gray line, when you subtract the 1.5, let's call it, and subtract roughly about 3% inflation, actually the May number jumped up a little higher than that, closer to 5. So we're kind of tracking the trend here, but you're seeing a negative, let's call it 1.5% negative yield roughly. And that just means you're losing out on your purchasing power if that persists. And so that's the big question. And it gets back to bonds. And we'll talk more maybe as we go through this about our view on bonds. But as interest rates rise, obviously it does create some headwinds for the bonds in the portfolio. And we've seen that this past year going back to the fall. And I think, well, we still see a lot of good attributes on the bond side to support having them from a diversification standpoint. We do want to be mindful that we have to temper our return expectations. And PJ will be talking a little more about inflation here in a minute and some of these transitory factors as we kind of dig a little deeper into that area.
Okay, well, so we get now to the fixed income yields, and I guess the question that is on a lot of people's minds is, at least in the first quarter, was interest rates were going up, and how far would they go, and at what point would they create an unsettled feeling in the stock market, or increased mortgage rates, or all kinds of other things. We've had it calm back down now, but let's talk about the interest rate side.
Yeah, that's a great question, Dennis. And so I think we always are thinking about what we call a choke point for the economy or for the economic growth. And so what that suggests is there a point where interest rates start to become prohibitive and start to create headwinds for the economy? Traditionally, and we're looking back, say 50 years or so, and you would hear a lot about a 10-year treasury being more in the 4 to 5% range. And it might be at those levels where you start getting a little concerned when it maybe gets above 5 and you start to say, hey, this may become a situation where either people are starting to get concerned about inflation running a little hot and interest rates are getting a little prohibitive. And you also think about from an investment standpoint, that's a pretty nice return. And maybe it's a safe return. I'll go there as opposed to stay in stocks. And so today, given the lower growth profile, and we are seeing that pick up quite a bit, kind of bouncing back from the lows of last year, interest rates are still very, very low, like we just described. And so we're thinking today that choke point is probably much lower. And once we cross, say, 2%, a 10-year treasury yield about 2%, we would start being a little more mindful about risk is starting to become, maybe it's 2.5, it could be 3, but we don't think we can get back up to the 4 to 5% days anytime soon, unless we see something really happen on the growth front. Maybe infrastructure will be part of that. The stimulus around infrastructure. We need some kind of growth dynamic to really improve that. So we see that as a moderate risk, probably low probability. I think it's something that we do expect rates to rise. And I think, once again, as long as it's in that constructive format with growth being, moving forward in a constructive fashion, we feel like it is very manageable. But I think right now we would say that we definitely need to see some of that and just the right dose. And I think as we transition to this chart looks at kind of where you be positioned in bonds, and yield is a part of that. And so if you think about bond returns or bond yields, is probably a better way to say it, you get paid more to take risks. So high quality investments like US Treasuries, and that's like the government blue section at the bottom left, you see that area being an area that doesn't pay a lot of yield because you got the backing of the government and they're generally considered very, very high quality. But as you start going into more of the outside investments, whether it's corporate bonds, kind of non-government bonds, or international bonds, you do have the opportunity to get a better yield, but you also have to be mindful that the correlation with stocks could increase. And that's what this scale is showing on the horizontal axis. You're seeing, as you move left to right, a higher correlation with stocks. And so then you look at the vertical and you say, okay, I can get more yield if I go from south to north. But as you look at how those kind of converge, you see that treasuries are in the bottom left, low yield, low correlation to stocks. But as you move more into these other areas, you're starting to get a better yield pickup, but also correlating more with stocks. So from an investment standpoint, even though it doesn't make sense to say, hey, why do I want to be in these low yielding securities? Just from an individual perspective, it may not seem to make a lot of sense. When you put that in the portfolio construct, they can actually add a lot of value from the diversification component and zigging when stocks zag. I don't know, Dennis, you and PJ have any other thoughts on this chart? That's kind of the way I think about it.
Yeah, well, and so I'm expecting that some of our viewers have probably still trying to struggle through how to evaluate this stock, but this chart. But I think the bottom line is that in this type of environment, diversification is a really good thing, and not just diversification within a particular sector. Would that be fair?
Yeah, I think that definitely is fair. You definitely always want to start with diversification, and it's just a matter of kind of where you lean and just recognizing we've all been kind of induced to take on risk this whole cycle of quantitative easing and stimulus because yields have been so low and everybody's been searching either for higher yields or better growth prospects. So it's either higher yielding bonds or stocks. And so we just got to be mindful of the risks there, because when you stretch for that type stuff, you just got to recognize your risk profile does increase. But diversification is a great foundation, and it's just a matter of being very calculated, understanding where you're leaning.
Okay. Well, so where did you end up rating inflation on the risk curve for either the economy or for different types of investments?
Well, I think, and PJ will get more into that here in the next couple of slides, but I think inflation is something we are once again seeing run a little hot. I think, individually, we all have different consumption baskets, and so it does impact us all a little bit differently depending on how we spend. So it's very interesting. Inflation may not impact us as much as we think, depending on those spending patterns, but we do expect it to be something that may be a little bit longer than is being advertised in terms of this transitory. We do believe it will be, but not thinking it's going to be something that we're going to see just spike up and then go away in a year or so. It may take another couple of years before things kind of subside. But overall, I think it's just getting that right balance and making sure, as PJ will describe in a minute, kind of what is driving the inflation and is it constructive given the economic growth profile?
Well, and to your point, I think it's interesting that we've looked at a lot of client budgets, and our client budgets are all over the map. There are some things that are consistent between certain types of clients depending on age, but there's different things they spend money on. And we found that only 30 to 40% of their budget items are subject to some of the higher inflation areas. Now, the question is, the rest of their spending, are they subject to either low inflation or even deflation? We've seen that some. And then there's that other piece that we see a lot, and that is the fact that there is just lifestyle inflation. And so people coming out of the pandemic, many of them want to kick up their heels a bit, whether that's buying a new car, whether that's an experiential trip, taking the grandkids somewhere, whatever it is. We see that lifestyle inflation, and some of them think it's going to be just for a year or two or three, and some of them think, well, life is short, I'm going to do this the rest of my life. So I guess this is one of those one size fits one situations for inflation in general and the way it impacts an individual.
Yeah, that's great. I'll add one other thing, Dennis. In terms of two big drivers of inflation for a long time now, you think about higher education costs, college costs, and you think about healthcare. And we have a little bit of control perhaps on the healthcare. If we take care of ourselves, maybe we can have a little bit less impact there if we do a good job on that front. We do know colleges are going through quite a bit with the online options and just different things there. It'll be very interesting to see whether that stays a strong component as well going forward.
Yeah, well, and we had a meeting with a client the other day that they have a 3-year-old and they're just hoping they can afford college. But again, to your point, hopefully the higher than average inflation rate in college educations will cool off some from what we've seen in the last decade. All right, so PJ, talk us through some of the inflation trends.
So what we're seeing on this slide is really looking back over the last decade at personal consumption expenditure core price index and how it's changed. It's just another term for measuring inflation. You have CPI, core CPI, here you have PCE. They're all using a slightly different basket of goods and what households they're surveying and things of that nature, but they're getting to a kind of consistent trend in terms of showing, are things getting more expensive or less expensive? When we've talked about the Fed over the last decade, the Fed's kind of been throwing out this target of 2%. You can see it identified here in that yellow line. And you can see that even with a very strong decade, I would say, from both, look at how the economy performed during the decade, you look at how the markets performed during the decade, and you look at all the printing of money through issuance of treasuries and what the Fed was doing, and they could not really get it to a sustained level of 2%. In the last year, they pretty much have said, okay, we're going to kind of abandon that 2% target and let it be more of a floating average over time. Still wanting to get to around 2%, but willing to let inflation run hot to get to a more longer term average of 2%. And you can see, with this last month, and again, this is looking at kind of year over year prints, and you see a large jump. Now, we all know that a lot of the jump is measured against a very poor time period. This one's looking at March to March. March of 2020 was the beginning of the COVID crisis, with many areas of the economy shutting down. Glenn mentioned throughout the number 5%. So if you look at May, CPI data year over year, we did have a 5% print. That was the first time that we printed 5% since August 2008. In no way am I saying that August 2008 is any way representative of where we are today, but we do know that the next month was the collapse of Lehman Brothers. A year later, we were printing negative inflation. So we had negative prints. So again, whether this is sustained or not is a little early to determine that. And Glenn used the word transitory, which many do believe that is the case. You are measuring right now against a unfortunately horrible year for the economy with the shutdown. And so for the next few months, we would expect prints to be very high on year-over-year inflation just because of the nature of comparing this year to last year. What'll be determining of whether this is more a sustained, 3 to 4% inflation rate will be when we start looking at January 2022, May 2022, and looking back to this year. Are we sustaining that inflation? When you look at what's driving it, two things that got us to 5% are energy prices. Oil's back above $70. You've seen that at the pump. We had a crisis with some offline gas lines in recent months that for short periods of time drove up costs, especially on the East Coast. Food prices, we know that last week there was a hack of one of the major global meat producers, and that took off some of their plants offline for a couple days. Again, you may be seeing some of that flow through in the prices that you're paying at the grocery store. Even if you take out both oil and food and you look at core CPI, year over year, we printed almost 4%. And so still relatively high. Some of the things driving it, you may have been, if you've been in the market for this, or if you've been hearing about it, used car prices have jumped up sharply. And on top of that, you're seeing with the economy opening up, people are wanting to go and rent cars, buy airline tickets, go to rent hotel, buy hotel rooms, and all those things are you're seeing increases in the prices. And so when we're thinking about how this might be a risk, if this is sustained long term, Glenn's already mentioned that high inflation rates are very painful to people in cash, people in bonds, because again, the erosion of purchasing power, when you have bonds yielding 1.5% and inflation is running at 3%, that's a negative trade long term. But other areas, if you have been owning a house the last year or two in many parts of the U.S., that's been great. As we've seen housing prices rise, and inflation is usually a positive for those types of real assets, infrastructure, housing, things of that nature. And so again, there'll be winners and losers in this, but it's still a little early to tell whether it's transitory or whether we're going to see a more sustained higher rates of inflation compared to what we saw the last decade, which was a strong decade for the economy, but not from an inflation standpoint.
Okay. Well, so let's move on to the next category.
And this is just kind of following on the discussion of inflation and looking at a few specific commodities. I think the one that people have seen mostly in the news and has been painful if you were building a house that had a floating contract price based on the cost of inputs, lumber. Obviously, you can see this is just the change since the beginning of the year. Lumber prices were up almost 100% at one point. They've fallen here in the last couple of weeks. But again, this has been mostly seen through when you're looking at new construction. There's definitely, we've talked to clients that they're under contract to buy a new construction house. The construction company has been put it on pause until the costs come down, just because it didn't make sense for them to complete the house, given how much they're going to pay for the inputs. But you're seeing in other parts, whether you look at corn here, you look at iron, wheat, some things are falling back down following May, but you do see how sharply they've risen year to date. And again, if this continues, depending on where the commodities are expensive, it affects the end pricing. And that end pricing, it passed along to a consumer, is just another input for causing inflation in different parts of the economy.
Yeah, and that gets to a very important point, and also some questions that have come in from our viewers. So supply chains have been significantly disrupted in the pandemic, and the pandemic end game, there is a lot of disruption going on. And we've even had a few of our clients talk about how they're trying to prepare for the outbreak of the Delta COVID variant in China's largest port, or one of the ports, that they're already seeing disruptions to their supply chain. And that Delta, by the way, came from India to China. So there's just a variety of supply chains, and some of the things on this chart tie into those supply chains. Some of our business clients feel like they're not in the same position they were in perhaps 10 years ago to pass through those costs to the end user. So, they're kind of stuck with trying to deal with that cost. And so we certainly understand many of the business owners who are viewers here, that level of inflation and some of the tough choices that are having to be made. But so one of the key questions we have here is hearing the term stagflation. Do you see that possibility? And first of all, define for our viewers what stagflation means.
So stagflation is a period of time that you would describe as being high inflation, but with that high inflation comes most likely high unemployment and also not very much growth. And so a period of kind of low growth, maybe even negative GDP growth and high inflation. So you're kind of pulling at two different sides of this. That is not a very good time for any of us, because at that point, it kind of just reinforces itself. With high inflation, things are expensive. And if there's no growth already, people may then continue to defer their purchases, which kind of keeps you in that loop until something, and it might be a Fed intervention, a Federal Reserve intervention that tries to get something going. Again, we saw all the different attempts last year to jumpstart the economy, keep people having cash in their pockets to be able to, just have the basic necessities of life. In a period of stagflation, that would be very painful. It's not something we see on the near-term horizon. It's not something that we believe that the government with their intervention is going to, they're going to do what they can to avoid it. They're going to try to keep us growing. Now, again, our growth rates, they don't look like China. They don't look like what they did look like 20, 30 years ago. A growth rate of 2 to 3% is expected here. That would be a target. But if you get that 2% growth and really high inflation, that's where this period comes in. So again, we don't see this on the near-term horizon. As the economy is opening up, we expect some strong growth, and we're not expecting the inflation to stick around past this, again, quote unquote, transitory period. But again, if we get into 2022, you still have upper single digit unemployment. You have kind of the inflation rates into 2022 continuing at 4 and 5%, and our growth has settled back down to what is more of a normal trend. That is a period where there's going to be some concern there. So I think until you get to seeing where inflation is going to settle, and that's going to be next year, it's a little too early to tell. But again, a period of stagflation for the U.S. economy would not be the desired outcome for anybody.
Well, yeah, and I guess people like Larry Summers and others remind us that the GDP figures were, those calculations were established for an economy 50 years ago. And they have been trying to figure out how to create some new numbers, because a lot of the GDP growth doesn't even reflect what's going on in the economy, and the digital economy in particular. And so a lot of forecasters are saying, well, you might settle back to 3% GDP growth, but the real number could be 25, 50% higher. And so that's another piece we got to keep in mind in the techno-industrial revolution. All right, let's talk about Federal Reserve balance sheet, everybody's favorite topic.
So I think on this slide, I'll explain in a minute, but we've used the word transitory to talk about inflation today a lot. A bigger T word that investors and other people are looking for is, when does the Federal Reserve mention tapering? And so what we're seeing on this chart is looking at the Federal Reserve balance sheet, going back to close to the beginning of the century. You can see that there was intervention in terms of increasing their balance sheet as a means of trying to spur the economy on, being very accommodative during the crisis back in 08, 09. But when you look at that the magnitude of the increase during that period, and that was QE1, QE standing for quantitative easing. Again, that's when they're buying assets. Most likely, and historically, it's been more in the treasury world, other government-backed securities. Last year, they expanded that broadly, buying corporate bonds, discussing buying ETFs, exchange-traded funds, back in March and April of last year. But you can see that the increase back in 08, 09 was about $1.5 trillion. We had another period of QE during the 2010 to 2012 period. If you recall, that was during the European debt crisis. Again, it didn't come across the pond and affect us too much, but it was something that there was some concern about potential spillover and contagion from that event that was more isolated to Europe. But then you look at 2012, 2014, we had another period, but then you get to what happened starting in March of 2020, at the beginning of the pandemic, and you can see that we expanded our balance sheet by the Fed expanded their balance sheet by 3.6 trillion. So almost doubling it from where it was. Again, they stepped in to buy assets to try to relieve pressures in the market and to try to, again, hopefully spur some growth is what their ultimate goal was, to protect the economy during a crisis. The question is, where do they go from here? Do they continue to expand it? And you can see the forecast here does show that it continues to rise, or do they begin to what would be called tapering, quantitative tightening, in terms of where they start to sell these government bonds back to the market and or just let them mature and not replenish. And so do we see their balance sheet start to decline? In the past, that's been a period where people might say, they're taking away the punch bowl at the party or something like that, where there might be some fear created by the idea of tapering. But I think we can mostly agree that tapering alone from where we're at is not going to cause a crisis, but it could cause concern. It could cause some reaction from investor sentiment perspective. But the path they're on, from a balance sheet perspective, is not, maybe you might not call it fiscally responsible in the long term. They took the necessary action during crisis, but to continue that, it's kind of putting us on a pathway to, how do we end this? How do we get out of it? The one comment I will make is that they're fighting two battles in that if they start to taper and they don't buy as many bonds in the markets, well, who's going to buy those bonds? And what prices will they demand for those bonds, or what interest rates will they demand? Again, we do know the U.S. government has a lot of borrowings, into the tens of trillions of dollars outstanding. And so, as those roll over and mature, we're going to have to go out and replenish and borrow more, or you have the option to print money. Those are the two options. Well, in the past, we've borrowed. And if you're having to borrow at higher and higher rates, that interest expense becomes higher and higher, and it becomes a pretty large item when you're looking at our budget each year. So again, they're kind of having to fight two battles with this. It'll be very interesting to see where they go. The next meeting of the Federal Reserve is next week, June 15th, June 16th. They will come out of that with a speech from Jerome Powell, and we will see, where are they, and what do they say? So that'll be something close to watch next week is the comments coming out of the Federal Reserve meetings.
Well, and one of the frequently asked questions that we get from our clients and centers of influence we work with is a lot of this Fed increase of balance sheet. The natural question is, well, don't they have to pay this back? And the answer is maybe. and again, that answer, people think of their own budgets. If they borrow money, they got to pay it back at some point, and they can't just kick the can down the road. But this is a little different animal when we're talking about the Federal Reserve. I think one of the other interesting components here that we've had a lot of questions on is, will the reality create more hiccups in the stock market, for example, of the Fed starting to taper off their accommodative stance? or will just talking about it create more issues? And again, we have a broad discussion in our frequently asked questions tomorrow in the written chat, poolside chat that's coming out. In our frequently asked questions, we tackle all these issues. We have a number of things and texture in there. And one of the things that we talk about is that the risk may be as much the Fed beginning to signal that they're going to do this, take away the punch bowl, as you mentioned, was the old euphemism. And back in the late third quarter of 2018, that actually created one of the worst quarters in stocks in recent memory. I mean, it was a really, everybody forgets it now, but the fourth quarter of 2018 was really a tough time for the S&P 500. And it wasn't because they were actually doing anything at the Fed. They were just talking about doing things. So, interesting psychology piece. All right, what are we looking at here? Global economic rebound.
Here we're just looking at kind of what we're seeing across the globe in terms of the economy. And, you think about what happened last year, and it was very, very deep in terms, very painful, the recession, but it was short-lived. At least so far, we are projected on track to be back above, where we were pre-pandemic with the current trend. And so I think the IMF, the International Monetary Fund, is projecting that this year, 2021, we're going to finish around 6% in terms of the growth target, which some people are thinking that could be a little conservative. And so, I think the story is, and it kind of ties into the stagflation comment that PJ answered. We are seeing that disruption in terms of the supply chain. And so we're seeing, supply being constrained, trying to ramp back up. And at the same time, we got the pent-up demand where, things are being demanded up front and we need to get things back going. And so it is creating a squeeze, and that's part of the reason we're talking about inflation. And to PJ's point earlier, as long as growth is rebounding, that stagflation risk is probably pretty low, but it gets to what's on the other side of all this. Once we get back up to his, you mentioned trend, in the next year or so, what does that look like? And do we have, a better growth profile than the 2.5%, 3% level here in the US, for example? So a lot to be determined, but I think the trend is positive, and I think we're all feeling fortunate that it was shallow and that we are moving in the right direction. And obviously, there's a lot to consider to talk about with some of the risk coming up in terms of what could derail things. But right now, I think it's happened about as best we could expect. I think looking back last year, you think about all the outcomes that could have occurred. And yes, it was self-induced. We realized that because the governments, we decided we need to shut down given what was going on with the virus. But to be where we are today, I think most people would probably say we're in a good spot. And it's just a matter of whether we can sustain this trend. And as we know, the market is anticipatory, and that's kind of the other decision. Is the market has been looking across the valley at this for a while, and has been anticipating this, and has done very, very well, even ahead of the economy. And so, obviously, it gets back to when you think about the stock market valuations today. Do you think are you going to bet on the come and this continues? And that's the big question: is are valuations reflective of where we think we're headed? And disappointment risk, execution risk is always something to be mindful of. But overall, I think this is a very constructive chart, and I think we just want to continue to monitor the growth trends.
Yeah, I mean, it was basically a year ago that there were many people suggesting that it could take 2 years or 3 years or even longer to get one viable vaccine, much less several. And so back in the third and fourth quarter, we had the whole thread the needle discussion in our back then, the fireside chats. And the thread the needle was that a whole series of things needs to go right for this V to happen. And in large part, that actually happened. So yay. And so, V, I've heard some people say V for vaccine, right? Or is that V for victory? What's that Winston Churchill thing? I think the pandemic endgame, a lot of people are thinking, oh, it's over. and it's not exactly over. And so that's another thing that we have in our poolside chat tomorrow is some of the discussions about the fact that herd immunity, even if we really are at herd immunity, doesn't mean the risk is gone. And, we have had some unfortunate situations with some friends of the firm, yeah, parents that decided not to be vaccinated, and one went to the hospital recently and never came out. And so just because you're at herd immunity doesn't mean some of the risks aren't still out there. All right, let's go to the next one. And this gets into the whole COVID vaccination. So PJ, where are we with all this?
Yeah, and so what this is looking at is the vaccines per day. And you can see that back when the US was doing 2 million plus vaccine doses per day, we were doing great back in April. We were early in terms of us in the UK and Israel in terms of getting access to the vaccines and rolling it out. We did very well in terms of getting it as in many arms as possible, as quickly as possible, once they're ready to go. For all the, I know there's missteps early on with some of the doses not, having problems with transportation, losing doses, things of that nature. But all things considered, I think we can say that what we've done, creating the vaccine, getting it to the percentage of the population we have is great. But with that said, right now, I think we're sitting around 50-something% have had at least one dose. The administration's goal was by July 4th to have 70% of the population to have one dose. It doesn't look like we're going to get there. You're kind of to that point with the access to the vaccines here and with how readily available they are in most parts of the country in terms of being able to walk into a clinic. They're still doing drives. At sporting events, you can get them. I was at one last weekend. They're giving out free vaccines. We kind of reached the point where it's probably, there's some people still on the fence, maybe waiting to see a little bit more data, but we kind of hit that point where probably the people that wanted it or have it and people that don't want it, it's going to be hard to change those minds. And so you can see we've declined. We're under 400,000 per day in terms of how many we're doing. Bill, can we go back to the previous slide? But you can see other countries ramping up, as they're getting access. This is showing that, parts of Europe, China, Canada's been a recent success story. They have actually, I believe, passed the US in terms of number of percent of the population that has at least one vaccine. We are well ahead on the fully vaccinated portion, but I believe they're over 60%. And you're seeing that the discussions between the US and Canada, reopening of the border is getting closer and closer with Canada. They've been very reluctant, but it looks like we're going to get there in the coming weeks or months. So again, it's good to see these rates picking up in other countries. Again, we just don't have enough vaccine right now around the world to get it to some of the emerging world. India obviously is the front page story in terms of an area that's really suffering. Brazil as well, parts of Africa. So again, you hope that you continue to see other countries get these vaccine numbers up as we move forward. And again, there's more and more vaccines being considered. Other parts of the world are using vaccines that the US never approved, the FDA did not approve. So again, the goal again is just to get a broader portion of the population vaccinated as quickly as possible, because Dennis mentioned the Delta variant came from India. I believe it's now the dominant, if not the dominant, in the UK. It is here in the US. For what we've tested, it's not dominant variant yet. But again, the variants that are more contagious, more deadly, affecting younger people more, again, that is a concern, because we have seen a pickup in hospitalizations among the younger people here in our country even recently. And so, like Dennis said, great improvement. And it does look like the clouds are clearing, but we're definitely not completely in the clear yet.
Yep. Well, and we should mention that at least so far, the vaccines that have been developed are effective against the variants, including this Delta variant. The concern is that if we don't get the whole world vaccinated or get to herd immunity, because remember, herd immunity is not just vaccinations, it's vaccinations plus the number of people already exposed who have the antibodies. And that number in the United States, I think I saw is above 70% perhaps, the combination of the two. But if you have some variant mutate overseas, like the Delta, but even more virulent. The problem is it'll find its way back here. And, we could be back at square one. Again, we would consider that a low probability risk because we've been in some briefings with infectious disease folks and even Moderna that have suggested we got this covered with the variants. But there's always that we don't know what we don't know factor. So again, I probably characterize this as low probability but high impact if it started to move in a negative direction.
Yeah, and the two things we'll learn over time is how long is the vaccine good for, and how long do you have antibodies after you've had COVID. So those are two TBD pieces that could affect whether we need booster shots, how often, what does that look like, if it's become the flu shot, but having to get things annually. So there's going to be a lot still to learn over the next 6 to 12 months.
All righty, and we should mention that I think it was just this week that Pfizer came out and said that they have a number of solutions for younger children, lower dose kinds of things for vaccines. And I think by the fall, maybe late fall, we're going to be seeing some of that rolling out as well. All right.
Yeah, this chart right here is kind of just another view of what's going on in the world, and you can see who's leading in terms of getting the most people, at least with one vaccine shot or one vaccine dose. And you can see it is picking up, which is great to see. Again, this doesn't include some other parts of the world that don't have access freely yet, as we do here, and even in Europe and China. Again, they're not all using the vaccines that you've heard of. There are a couple others made in China and Russia that are being utilized. But again, it's good to see the trend in some of these countries, South Korea, India, Japan, but we hope it accelerates. Again, like Dennis mentioned, getting the whole world as many people vaccinated is the important part of this, not just our country. Given the way that travel works and the way everybody opening up, we're going to be back to people traveling all over pretty soon. And so it is key that we get the world vaccinated.
Yeah, so we do have a number of clients who've asked the question about, is it a good thing that the Biden administration has decided to provide these, 500 million doses of vaccine worldwide. Is that a good thing or a bad thing, considering that our country is not fully vaccinated? But does that go back, PJ, to your earlier comment that there's fewer and fewer people that really want the vaccine in our country?
Yeah, man, I'm not expecting us to run into a scenario where we have a shortage, unless it's from booster shots, maybe like something like that. But it's hard to envision us running into a shortage at this point, given where we're at, unless something significantly changes in people's desires that are out there.
Yeah. Okay. All right. So now we get into geopolitical risks, and one of the things that we remind everybody is that some of these things are always around, and generally speaking, going back many, many, many decades, these are things that if they happen will grab the headlines for 6 months or 12 months, but they actually don't affect the stock market or real estate or other investment classes for much more than 12 months. So, the old stats were 96% of the time you should ignore pretty much everything on this page for their short-term impact. But let's get into this list because some of the risks are definitely elevated.
And I'll talk about U.S.-China first. And this has been an ongoing conflict as the two largest economies in the world, not only fight for, being the largest economy and having the growth and everything of that nature, but you're looking at, we talked about before, IP, fighting over IP rules and whether, the stealing of potentially IP. But really the tension.
IP is intellectual, right?
Yeah, intellectual property. So taking, the ideas of technology companies in our country and stealing them and applying them into their corporations over there. You've heard a lot of it with different companies, especially in telecom over there. But really thinking about the broader tension, and what would potentially lead to issues here. You think about a few flashpoints that could come up over the coming years, and you look at South China Sea, you look at Hong Kong, what happened last year even, you look at Taiwan. Again, there's lots of things where, if China took action, what would be our response given our relationships with those areas over there? There's a book, and if you want to read more about this, a book that you could read is called Destined for War by Graham Allison. He does a great job of talking about the potential flashpoints, but what also could be done to avoid these flashpoints. He talks about what the main focus of the book is, the idea of the Thucydides trap. When you think back to the fighting in Greece and the different factions back in Greece many, many centuries ago, the idea was that there's always a superpower and an emerging superpower, and that usually leads to a conflict. And that is what we have with the US and China. I think both countries want to avoid a military conflict, but military conflict in this instance would probably not look like what you think of when you think of military conflict. The war be fought in cyber, and you're already seeing that with different areas of what can be done with cyber attacks. When you think of what could be going on in space, and that's more going to be thinking about satellites. Satellites are kind of the eyes and ears of the US military. Well, depending on what happens with those satellites, we may or may not have as much knowledge of what's going on around the world if there was action taken by China or anybody else to take some of those satellites down. So again, there's lots of things that could potentially go wrong with China. I do think both countries want to avoid the extremes, but there are going to be these tit for tat hits along the way from both sides. I don't know, Glenn or Dennis, if you want to add anything to this topic that we could talk about for 30 minutes or an hour, probably.
Well, and it is the lead topic in our poolside chat tomorrow. So we get into a lot of depth on China and some of the issues there. But, I think the conundrum, and we've had officials within the China trade talks and others tell us that the dilemma here is that the more China gets interwoven in the world global economic stage, the less they want to upset that apple cart. However, they have things they think they can get away with in their own backyard, and even Africa to an extent, that we probably aren't going to want to intervene on. So yeah, a lot of potential flashpoints here.
Yeah, I'll just add, I know Biden's obviously traveling to the G7 this weekend, and he's trying obviously work on alliances with some of the members of the G7, and I think that's going to be key, is continue to work on that front. And he's going to be meeting with Putin, I think, mid-June, and so Russia, along with China, I feel like, Dennis, you're the chess expert here, but we are playing a little bit of a game of chess with some of these countries, and it is a little bit more of a power struggle. Everybody wants to be the top dog, and I think, it is going to be more about, I think, alliances, negotiations, and standing firm a little bit, like we've been doing some past several years, and just letting them understand, there is a point where we're not going to, we're going to push back. And I think, it kind of gets into North Korea, Middle East. There's just a lot of, needs around the globe to address. And I think it's going to be challenging because, I think as the economy improves, I think hopefully that will maybe lessen some of the tension, because, when you have a good times, maybe some of the social unrest alleviated, but there's still that power struggle. And, you got some of these folks have their own agendas. And so I think we're going to continue to be talking about just strategic positioning, whether we're dealing with China, Russia, North Korea, the Middle East. I think those are going to be ongoing considerations, and for a while now.
Yeah, well, and I guess one of the good news things, and we do report on this in tomorrow's poolside chat, is that the Chinese may have blundered here recently when they basically pushed back on Europe for some economic sanctions and created some economic sanctions of their own back to the Eurozone, because the Eurozone was actually, over the last couple of years, drifting closer to China and getting more in bed, so to speak, with China. And again, some folks may remember our chat topic some years back about the whole Belt and Road Initiative, the largest infrastructure project on the planet Earth ever, and which is saying a lot. And that Belt and Road happens to go right into the Eurozone from China. And so the Europeans have now done an about face after a couple of months ago getting the slap in the face from the Chinese. And now they're sort of getting cozier with us. So again, I don't know if it's chess, Glenn. I hope it's not a game of Risk. If anybody remembers that game from your youth. It may be a game of Go, which I am told is even more complex than chess. There's just a lot of moving parts here. So the major cyber attacks, this is the one that a lot of our clients really are concerned about. I mean, they're concerned from a private level of getting their identity stolen or getting their own data hacked. And I still remember being on the phone with a client not that long ago, and it sounded like somebody just came on the phone line, randomly, and she was very concerned that somebody had hacked in and was listening to our conversation. But the cyber attacks, certainly after the Colonial Pipeline, have taken on a bit of a new meaning. So talk a little bit about that area.
Well, it's definitely been an area that we've been devoting more resources to for quite some time because it's a growing risk. And I think it's getting much more sophisticated. And obviously, we've seen more and more here in our country, with potential Russia involvement, at least there's much speculation there. So I think, it's an area that's going to require companies, governments to continue to allocate more and more time and attention and resources to, and it's getting very sophisticated. So I think that's going to be an area in a business that's going to continue to flourish. Unfortunately, it's going to have to. And I think, it's an area that's still very, very high risk. And I think like a lot of these risks you mentioned earlier, Dennis, they can be very impactful short term, and generally we recover, and it's not as much a market impact over the longer haul, but it can be very disruptive. I don't know, PJ, if you have any thoughts on that, but that's my initial take.
Yeah, I mean, I think you're thinking back to like we talked about, this isn't talking necessarily about having your identity hacked, which definitely is an ongoing issue for many. But you think back a couple of years to what happened in Iran when their nuclear energy facilities were taken offline by a cyber attack. There so many of our facilities are hooked into the internet in some degree, whether that be a dam here in this country, whether that be other types of large infrastructure, electrical grids being a big one. So again, to date, there's been obviously some intrusion. Many times the intruders there, if they don't take action, you don't even know they're there. So knowing, how far along anything is tough. But this risk is going to be here and with us to stay. It's one of those things that, as we've gotten more technology and the world's become more interwoven via the internet, this is a unfortunate side effect that's come along with it, is the risk that something large is taken down. Again, to date, we haven't seen anything that would be more than noise for the long term on a countrywide scale, but that risk definitely is there, and something that we're continuing to monitor. And I know that our government is doing its best to try to play defense, but this is not an easy game to cover all of your potential holes.
Yeah, and this is probably going to be the subject of a future either live chat or written chat, because we do have a lot of questions around it. I will mention that one of our IT experts, independent firm that we frequently hire, now talks about, for the individual, corporations too, but for the individual, having multiple layers of security. So having security in your own Wi-Fi network, having security within your own device. And then the third level is there's now things that are available that encrypt data that flows through email streams for individuals. I mean, we've had them in our own business for a while. And so again, if you're worried about it on the individual side, you can certainly go to a deeper level without just getting rid of all your devices.
Yeah, and Dennis, one thing I'll add that we recommend for our clients and all of our employees is, for your bank accounts, for other very sensitive things, use two-factor authentication, meaning not only having a password, but then having a second check where it might text you a code or email you a code, so that somebody would have to get access to multiple parts of your life to then get into your account. So turning on two-factor verification, which pretty much every major major financial company is utilizing right now.
Yeah, and best practice there is to not put the second factor plus your password in a sticky note sitting on the front of your computer, so that a 16-year-old grandchild's friend can't see some of that. Okay, we have some questions about global taxes and corporate profits. Why don't we jump to that one?
Yeah, maybe I'll lead off and let PJ wrap up. So I think here, and this can be somewhat political, obviously, and I think, I see points on either side of the aisle here. Taxes have been lower and they've been higher. And I think we've seen the economy, the markets move forward in any environment. I think what I'm hoping is that we get some good balance here. We recognize that we want the economy to grow. Maybe we can find a happy medium. We know, and I think Dennis, you highlighted this on one of the recent chats, in terms of the corporate tax rate, in terms of that kind of 28% sweet spot, I believe, and just making sure that we don't, get too short-sighted and try to raise it too high and kind of, then realize we're just kind of choking off some of the growth and the profit piece. So I'm hopeful that, based on some of the more recent discussions, at least I'm seeing that they are having those discussions and that they are reaching across the aisle, and that we're getting more of a approach that's balanced. And I think that's at least what I'm hoping for. And it seems like, we are expecting things to go up some. And I think corporations will be able to adapt, but it needs to be, I think, just in a good, hopefully balanced fashion. I don't know, PJ, if you got anything you want to add there.
Well, I think outside the U.S., there's been discussion this week, and there'll be more this weekend at the G7 about a more broad or global tax, as you might say. Especially they're focused on technology companies right now that have revenues in different parts of the world, and all that might not be taxed right now. And so they're trying to come to an agreement that the countries, at least in the G7 and maybe broader, can agree to be able to tax some of these profits that might not be on the home where the home of the headquarters is of the companies.
Yeah, and that was one of the surprising things that Janet Yellen seems to have got accomplished, where, she's gotten agreement from at least the top 7 countries. Now, she still has to get it from G20, which is the top 20 countries, which includes Ireland. And Ireland has a 12.5% corporate tax rate, but she's got an agreement from the G7 to do a 15% minimum corporate tax rate. And which is not that far from a 12.5, but it does affect, a lot of technology companies, as you mentioned. So I guess it's good for them that we're in the techno-industrial revolution and they're going to have some good earnings growth, but this is going to take some of that earnings growth and siphon it off. All right, well, we'll continue to report out on that particular issue. We are reaching the top of the hour here. I don't know which of these we want to talk about. I know there was the CNN piece on North Korea that because of Kim dropping weight, that they considered that a risk in North Korea. North Korea has been off the headlines here for a while.
And I think there's just concern about health, and if there was an event over there, obviously we don't know a lot that goes on behind closed doors about how he's doing health-wise, but I think the concern is what a political transition would look like, and what the new power and the new administration, if you want to call it that, would look like when they come in. So I think that's the concern there. That's always going to be there until something does happen to him. I think, we can quickly touch on a few others. The Middle East tensions, the emerging market political crises, these are here to stay. They've been here for a while. We had our recent flare up between Israel and what was going on in Gaza and the Palestinians, obviously with Hamas driving that. And you'll continue to see little flare ups in that region. Again, the larger players of Saudi Arabia and Iran, that would be a much bigger issue, especially if Israel is involved with any type of tension there. The emerging market political crisis, every year, every day, there's one going on. Right now, you could point to Myanmar, you could point to Peru, Brazil, Belarus. So again, there's always going to be political crisis, but those economies we just mentioned outside of Brazil, we're going to view that more as noise. With Belarus being a little bit bigger deal, obviously, because it is sitting in between Europe and Russia, and with the recent, we'll call it hijacking of the plane, whatever we want to call it, the plane landing in Belarus and taking off a citizen, and having sanctions from one side in Europe and potential support from another side in Russia, that is a noise that could grow bigger just with who the players are involved. And so that's something we're always wanting to understand is the direct conflict, but then who are the players that this could affect or who could become involved. And so that's something that we're constantly monitoring.
Well, and European fragmentation, if we had more time, we'd probably talk about that. And we do have a piece on that in our written chat tomorrow about the fact that Angela Merkel has been part of the reason, the Chancellor of Germany. She has held together a number of parts of Europe, and at the end of this year, she will be riding off into the sunset. And so the question is, what happens then? So a lot of issues here. Why don't we wrap up, Glenn and PJ, with what are the 2 or 3 things that you think are most top of mind, things that you think we got to pay a little bit more attention to here short term?
PJ, you got any thoughts?
I think, and I'll use short term as a year. It's hard to know what's going to happen tomorrow, but I think inflation and U.S. China are 2 things that if inflation does persist at a high rate, we're going to need to rethink some things going on, and then probably rethink how you might position the portfolios. And I think next year, I believe China is hosting the Winter Olympics. I don't think they want to ruffle too many feathers in advance of that, but post that, you could see some flare-ups in certain situations over in that part of the world. And then what would our response be? Is something that I think to monitor in the next 12 to 18 months.
Okay, Glenn?
Yeah, I'd agree with that. It seems like definitely inflation, interest rates are very top of mind for a lot of folks as we recover. And I would also, kind of to your point, PJ, earlier, I want to see what it looks like on the other side. I think we know the economy is rebounding sharply, as we've already described, and we know the reasons behind that. But as we consider this infrastructure spending stimulus piece and hopefully get a good balance there, is there anything that can get us to a higher growth point than that 2 to 3%? We know the baby boomers retiring. There's been a lot of things that have justified, our lower growth profile over the last number of years. But is there anything we can do to spur that higher? And Dennis, you talk a lot about the tech, the industrial revolutions and things like that. I'm really curious to see if infrastructure can give us a little more pop, or there's some things we can do just to improve our growth profile once we go on the other side. Because that'll be a key for where we go from here, I think.
Yeah, and I think one of the things that we have to continually be thinking about is that in an environment where there are multiple low probability but high impact possibilities floating around, is to always have some safety margin, personally, portfolios, and we're in an environment where many of our clients are continually saying, well, we may be at the lowest bond point ever, but why don't we go lower? Well, and that's part of the issue, is that, bonds, we're not expecting much out of them the next 3 to 5 years in terms of return over inflation, but they're part of the insurance policy. So how much of the insurance policy do we get rid of and then have one of these multiple kaleidoscope issues, flare up? So again, I think that comes down to every single conversation we have with those of you who are watching, your own unique circumstances, your own unique spending habits. All of that fits into the equation of how many layers of security you need for your own personal, be able to sleep well at night and weather whatever comes in the future. All right, well, we've covered a lot of things. We appreciate everybody's attention. Again, it has been recorded, will be available on our YouTube channel shortly. I would suggest looking at the poolside written chat that'll be coming out tomorrow morning, which will give a lot more texture in some of these areas. And again, keep those cards and letters coming. Let us know what's top of mind for you, and we will try to cover them either in the written chats or the poolside chats or other special reports that we do. Thank you, and hope everyone has a wonderful weekend.